Hi, thanks for listening. Today I'm going to explain the cheapest to deliver basket and its financing nuances. So first of all, what is a basket? So the cheapest to deliver basket is pretty much quants at the Mercantile Exchange find a bunch of eligible bonds because of financing and other market price reasons that could fit into it, and they create the basket. If you go to the CME website, you'll see they release every Wednesday an Excel file showing the entire basket for each contract and its conversion factors. Here's the example. You can kind of see it would show coupons, conversion factor, which is also the ratio roughly of cash bonds to future. It's a bit more nuanced than that. So if you were doing like a real desk relative value trade, you wouldn't want to do that exactly, but it's roughly that, and it gives the CUSIPs and delivery types as well. So what does cheapest to deliver mean? Like which bond is in there? So you want to think in terms of the position that is long the cash bond or short the futures. And that's called the deliverer. So that's somebody, let's say I held all the bonds within the basket and I was long them and I was short the future, I was going to deliver it out in time. Um, we'd be thinking in my perspective, and we would be looking for the best economics for me, whether that's the minimal loss, maximum gain. And it's really nuanced. A student way to understand this is to look at the dirty price of the cheapest of the baskets, look at the potential fair value invoices price, and you would look at the lowest net basis by that. But in real life, I'll get to this later on, it's really nuanced because market trades on the repo curve and other expected situations, or just liquidity stress in general. And this image kind of shows how it works. You see different different bases, and the best delivery economics is bond D, and you can see it marks it here. This is the cheapest to deliver. I would, if I was long the cash bond, short the future, I would have a gain of 1.25, whereas bond A would be losing 2.5. And these are just points, not converted to anything right now for like a trading desk. But it really emphasizes that you want to think in terms of the parties that are delivering the bond to understand the economics for cheapest to deliver. Here I'm going to go into the nuance of ideal fair value versus market traded. So you can calculate with repo dynamics and other financing equations what the ideal fair value futures price is and what the ideal cheapest to deliver by that metric would be. But the issue is markets don't trade like this. If you're a futures trader, you would know the term rich versus cheap curve, where implied financing rates can diverge from their ideal. And you can see situations where the market futures will say one of the bonds in the basket should be cheapest to deliver. It's trading by that. But the fair value says it should be this. And as a trader, you're going to go with what the market says. And that could be because of surprises in the Federal Reserve. During that 2023-2022 inflation scare, you really saw this happening, even just quick intraday divergences where narratives take over, fear takes over. So it's not even just pure quant of the divergence. There's a liquidity aspect to it. I mean, if you're a futures trader, you'd kind of recognize this, but you can see this is kind of just an overview, but you can see there's rich and cheap situations where the market may be pricing a different cheapest to deliver than your ideal math would state. And that's a nuance that's really important because as a junior analyst, it's tempting to just say this is the ideal, this is how it works, but sometimes the arbitrage is around the market price. And it's just really difficult because then you have to talk to seniors, you have to talk to economists. Why is the market trading here? Is it inflation scares? Is it liquidity? Is there some sort of retail narrative going on? And it's a lot of nuance to that one. And why does this matter though? Like, why are we discussing this? First of all, even just a very basic, generic speculative contract on interest rates, longing or shorting it, that's going to be extremely priced on the cheapest to deliver. So even as a desk, you can't even do the most basic trades without understanding the CTD, understanding the financing of the basket. And then when you get on to modern trades that are using swaps, some trades, not as many using total return swaps, they're interest rate swaps, yield curve, relative value, you have butterflies where you have a bunch of delivery mechanics going on. If the basics structurally requires understanding the basket, then you can see just how difficult this gets. And the next image right here, I mean, this is a very simple, but you can see even between the two futures contracts, there's different convexity. Now I think the cheapest to deliver to those futures also has convexity mismatches. Then you're going to get to second order convexity. You're going to get to really complex ideas, and you're seeing you can't skip the basics of the financing of the basket. You can't skip the basics of shock, future shock ratios. And then when you have these really complicated 3-4 leg treasury trades, you're getting to see everything's starting to become this really nuanced financing trade. And you got to understand the basket, because if there's a basket rollover on just a 5 to 10 year trade and you didn't catch up with that, you're going to see those hedge ratios start to slip up even intraday. And the final nuance, I already brought this up earlier, is when you're analyzing treasury securities, treasury futures, you want to look at what the market prices and then work it back to why you believe that. It's actually almost impossible to perfectly model the basket, but you can make hypothesis of why the market prices it. Modern fixed income trading, especially around the Treasury's ecosystem, can be highly leveraged. So you wouldn't want to just take a LTCM strategy of just putting out a lot of math and saying this is ideal and leveraging on it. Instead, you would be wanting to watch the market and then work back into the basket saying, okay, this is a really strange coupon financing situation, but the market says it's cheapest to deliver. Maybe we see a bear steepener happening, and this is dealers, some other factors like implied optionality or something. But the thing is, like, even when I'm working on it, I kept seeing all the models I kept trying, none were perfect, and that's because you can't be perfect on this. You've just got to watch how the market trades, and then you can start to explain, unfortunately, sometimes post hoc, why that happens. Anyways, thanks for listening. That was just my short overview. I hope that helps you learn more about the cheapest to deliver, the baskets, why there can be divergences of what the actual CTD is and what your model might say it is. And yeah, I'm just trying to explain more, make finance more accessible, and make it more transparent. Thanks for listening.